Sarepta Therapeutics, a company built on one mission, finding cures for children with Duchenne muscular dystrophy, one of the most devastating rare diseases known to medicine.
DMD robs boys of the ability to walk, then breathe, then survive, usually before age 30. Sarepta has spent decades engineering the science to stop that clock.
The company traces back to 1980 as Antivirals Inc. in Oregon. For 2 decades, it explored RNA chemistry in relative obscurity. Then came the pivot that changed everything.
In 2004, the company renamed itself Sarepta and zeroed in on Duchenne. RNA-based exon skipping became the first mechanism, tricking the body into reading around the genetic error that causes DMD.
EXONDYS 51 hit the market in 2016. Then Doug Ingram joined as CEO in 2017 and pointed the organization toward a bolder prize, gene therapy. In 2023, ELEVIDYS became the first FDA-approved gene therapy for DMD.
Revenue runs on 2 tracks. ELEVIDYS drives roughly half of total sales. The legacy exon skipping franchise, EXONDYS 51, VIANS 53, and AMONDYS 45, generates substantial recurring revenue from different DMD mutation subsets.
A Roche collaboration adds milestone payments and royalty-eligible geography outside the U.S. Sarepta keeps domestic rights while Roche handles international markets.
The unit economics here are unusual. Gross margins exceed 80% on gene therapy. Once manufactured and approved, the cost to treat each patient is relatively fixed, while revenue per patient tops $3 million.
But R&D spending consumes nearly 70 cents of every revenue dollar. Sarepta is still investing heavily, expanding ELEVIDYS eligibility, defending its IP, and building gene therapies for limb-girdle muscular dystrophies.
Competitively, Sarepta holds a rare and durable moat. Only a handful of companies have the regulatory precedent, manufacturing expertise, and clinical data to commercialize a DMD gene therapy at scale.
BioMarin is the closest comp, a profitable rare disease specialist with deep commercialization muscle. CRISPR Therapeutics and Intellia bring next-generation gene editing science, but remain pre-commercial in most programs.
Sarepta scores highest on rare disease moat and pricing power. The ELEVIDYS price is among the highest in pharmaceutical history, and payers are covering it. That negotiating position is exceptional.
The Gene Therapy Patient Reach Network tells the access story. Sarepta certifies specialized treatment centers, hospitals, and academic medical centers equipped to administer the one-time infusion safely.
Those centers connect to roughly 10,000 DMD patients in the U.S. Each new certified site expands addressable reach. The bottleneck is payer authorization and patient identification, not the science.
Leading Sarepta since 2017 is Doug Ingram. A lawyer by training, Ingram had run Allergan's pharmaceutical division before making the rare disease leap. He is regarded as one of the most effective rare disease CEOs in biotech.
Ingram is known for precision on regulatory strategy and his ability to execute a complex commercial launch. His compensation is tied to long-term milestones, patient access, revenue, and pipeline delivery.
Sarepta Therapeutics, a high-stakes, high-reward biotech at the frontier of gene therapy. The science is validated. The commercial launch is real. The question is how fast payer access and patient uptake can scale the revenue curve.
All eyes turn to the next quarterly earnings report, where ELEVIDYS net revenue, payer coverage rates, and pipeline updates will tell us whether this gene therapy story is delivering on its extraordinary promise.
Sarepta Therapeutics reported Q1 2026 total revenues of $730.8 million, but $400 million of that is non-cash collaboration revenue. Net product revenues were $330.5 million, down 46% year-over-year, as the ELEVIDYS label restriction compresses the gene therapy franchise. Non-GAAP EPS of 316 crushed the 109 estimate. This is Charged Alpha. I'm Hudson.
And I'm Lana. Sarepta is a precision genetic medicine company focused entirely on Duchenne muscular dystrophy. Their portfolio spans 3 PMO exon skipping therapies, EXONDYS, VIANDYS, and AMONDYS, plus ELEVIDYS, the first FDA-approved gene therapy for Duchenne. These treatments target genetic mutations that prevent dystrophin protein production in patients with this severe pediatric disease. Market cap is approximately $10 billion.
Doug Ingram has led Sarepta since 2017. transforming it from a single-drug biotech into a multi-franchise rare disease platform. He won the FDA approval battle for ELEVIDYS in 2023, the first gene therapy for Duchenne, and is now navigating the post-approval restriction that narrowed the drug to ambulatory patients only. Managing the ELEVIDYS recovery is the defining execution challenge of his current tenure.
Q1 total revenues include $400 million in non-cash collaboration revenues, $325 million from Roche's declined option, plus smaller milestone payments from international partners. These are one-time accounting recognition events, not recurring drug sales. Net product revenues of $330.5 million represent the true commercial performance of the underlying business and the correct year-over-year comparison.
Net product revenues fell 46% from $611.5 million in Q1 2025 to $330.5 million. The collapse reflects the FDA restriction narrowing ELEVIDYS from a broad Duchenne patient population to ambulatory patients only, implemented in late 2024. Non-ambulatory patients represent the majority of the Duchenne population as the disease relentlessly progresses with age.
ELEVIDYS gene therapy revenue was $102 million in Q1, down 73% year-over-year from the prior year period. Before the restriction, ELEVIDYS treated a broad Duchenne population, driving hundreds of millions in quarterly revenue. The ambulatory-only label eliminated eligibility for the majority of patients. Sarepta is now rebuilding from a substantially smaller addressable pool within the current label.
PMO products, EXONDYS 51, VYONDYS 53, and AMONDYS 45, delivered $228.6 million in Q1. These antisense oligonucleotide therapies enable partial dystrophin production by targeting specific exon mutations in Duchenne patients. Unlike ELEVIDYS, which is a single administration, PMOs require ongoing dosing, providing Sarepta with a stable, recurring revenue foundation underneath the gene therapy franchise.
Non-GAAP EPS of $3.16 beat the $1.09 estimate by 190%, driven by collaboration revenue recognition, not operational outperformance. GAAP net income swung to $331 million from a $448 million loss in Q1 2025. Strip out the $400 million in non-recurring collaboration revenues, and the underlying profitability picture is considerably more modest for the quarter.
Full-year guidance targets net product revenues of $1.2 to $1.4 billion, explicitly on net product revenues to exclude the unpredictable collaboration revenue line. The midpoint implies sequential ELEVIDYS recovery across Q2 through Q4, while the PMO base holds stable. Achieving the guidance range requires physician adoption of ELEVIDYS within the ambulatory label to accelerate meaningfully from the $102 million Q1 quarterly pace.
Analyst reactions split on what metrics mattered. The 190% EPS beat looked enormous in isolation, but professional investors recognized it was collaboration revenue-driven. The real debate was whether net product revenues and ELEVIDYS ambulatory patient growth were actually tracking toward the $1.2 to $1.4 billion guidance range for the full year.
Bulls viewed Q1 as consistent with the label restriction transition timeline. The key variable is how fast prescribing physicians build ELEVIDYS confidence within the restricted ambulatory indication. Sequential growth from the $102 million Q1 baseline across Q2 through Q4 is necessary to hit guidance. Bulls believe this ramp is underway and will accelerate as real-world ambulatory efficacy data builds in the prescriber community.
PMO dynamics add important nuance. As ELEVIDYS broadened pre-restriction, some patients shifted away from PMO therapies. Post-restriction, patients ineligible for ambulatory-only ELEVIDYS have partially reverted to PMOs. Whether this PMO recovery is durable or temporary, as ELEVIDYS prescribing rebuilds within the restricted label, directly affects how analysts model the $228 million PMO baseline going forward.
Bears focus on the structural ELEVIDYS ceiling. The ambulatory Duchenne population is significantly smaller than the total disease population. Non-ambulatory patients represent the majority as the disease progresses. Even at full ambulatory penetration, gene therapy revenues face a structural cap well below the pre-restriction peak. Without label expansion back to non-ambulatory patients, the drug may plateau permanently below prior modeling assumptions.
The 5% post-earnings decline, despite the massive EPS beat, reflects investors reading through the headline to net product performance. Those tracking net product revenues saw an in-line but not upside quarter relative to the guidance trajectory. The divergence between total revenue, which looked excellent, and net product revenue, which showed a 46% decline, created significant interpretation noise around the Q1 results.
The bull case centers on label expansion. Sarepta is running clinical trials in non-ambulatory Duchenne patients with the goal of restoring the broader indication. FDA approval to expand Elevidys back to the full Duchenne population would significantly recover the revenue ceiling and reopen the gene therapy franchise's peak potential. Label re-expansion is the primary catalyst driving optimistic price targets among biotech analysts.
The PMO Cash Flow Foundation provides critical runway. $228 million per quarter in stable product revenue funds financial runway, while the Elevidys ambulatory base rebuilds and the label expansion clinical program progresses. This reduces urgency around near-term gene therapy acceleration and gives management time to execute the regulatory strategy without immediate financial pressure from the ongoing product revenue decline.
Pipeline optionality adds a third bull dimension. Sarepta has next-generation Duchenne programs and additional gene therapy assets beyond Elevidys. If any late-stage pipeline program generates strong clinical data, the narrative shifts from single-franchise label restriction recovery to a multi-franchise rare disease platform, potentially at a higher valuation multiple than the current constrained single-drug story.
The bear case leads with permanent label restriction risk. FDA post-approval narrowings in gene therapy are difficult to reverse. The agency requires substantial new clinical evidence. If non-ambulatory Elevidys trials fail to generate compelling efficacy, the restriction becomes permanent, and the revenue ceiling is set structurally below prior peak levels indefinitely.
Competitive displacement adds long-term risk to the franchise. Multiple developers are advancing Duchenne gene therapy programs with potentially more durable transgene expression or improved delivery mechanisms. A competitor receiving FDA approval for a superior Duchenne gene therapy would directly threaten Sarepta's first-mover advantage among the ambulatory patients who currently represent its entire addressable gene therapy market.
The patient timing window is closing as the restriction persists. Non-ambulatory patients aging through disease progression, while Elevidys is restricted, miss their therapeutic window entirely. Gene therapy efficacy decreases significantly as DMD advances. The ambulatory patient pool has a natural depletion dynamic as patients age out of ambulatory status, compressing the recoverable opportunity even if label expansion eventually succeeds.
Balance sheet risk amplifies the bear case. Sarepta carries meaningful debt accumulated from funding Elevidys development and launch. If product revenues continue declining and collaboration revenues normalize to zero, the company faces cash burn at the current cost structure. Debt constraints limit operational flexibility and amplify downside risk if Elevidys ambulatory revenues fall short of guidance.
Moderna is the peer by market positioning. Both are genetic medicine platforms navigating post-peak revenue transitions with pipeline-dependent growth stories. Moderna is managing post-COVID normalization while building an mRNA therapeutic pipeline. Both companies rely on clinical and regulatory execution to sustain premium valuations, making pipeline outcomes the primary relative performance driver in the near term.
Bluebird Bio is the closest rare disease gene therapy peer. Bluebird has FDA-approved gene therapies for sickle cell and beta thalassemia, single administration treatments for narrow patient populations. Their payer negotiation experience and access dynamics directly inform how the market values gene therapy pricing economics, which is highly relevant to Elevidys reimbursement and patient access.
Adidas Medicine represents next-generation CRISPR gene editing pressure. Editas is earlier stage but targets overlapping rare disease applications. If CRISPR-based approaches prove more durable or broadly applicable than viral vector gene therapy, companies like Adidas could compete for future Duchenne patients, representing long-horizon competitive risk to Sarepta's gene therapy franchise.
On valuation, Sarepta at $10 billion implies 7 to 8 times the guidance midpoint on net product revenues. For a company with a label-restricted primary growth driver and GAAP losses absent collaboration revenues, this multiple prices in meaningful optimism about either label expansion success or pipeline optionality that current operating results and the product revenue trajectory do not yet fully support.
Sarepta options heading into Q1 showed elevated implied volatility, standard for a catalyst-rich biotech with binary outcomes around clinical and regulatory events. Pre-earnings put buying was notable, reflecting investor concern about whether Elevidys' ambulatory revenues were actually tracking toward the guidance midpoint. The elevated IV priced in a larger post-earnings move than the 5% decline that materialized.
The 5% post-earnings decline was narrower than the implied move priced before the report, suggesting the market had positioned for a larger negative surprise. Collaboration revenue noise complicated the options settlement. Investors positioned for EPS upside found the stock moving against them as the market correctly focused on the underlying net product performance rather than the inflated collaboration-driven headline.
Insider activity follows executive diversification rather than directional conviction. CEO Ingram has maintained his equity position without notable open market purchases since the label restriction, consistent with management confidence in the long-term direction, but without a personal capital commitment signaling near-term urgency around the stock. Board compensation structure aligns executive incentives with Elevidys' clinical recovery and pipeline success.
The combined read is cautious neutral. Options priced more downside than materialized. Market anxiety exceeded the actual result. Insider behavior reflects long-term alignment without near-term urgency signals. The story remains binary around whether Elevidys' ambulatory revenues recover to guidance and whether label expansion data ultimately supports a return to the broader indication. The 5% post-earnings decline is a holding pattern.
Sarepta's Q1 headlines look positive, but collaboration revenues obscure the product reality. Net product revenues are down 46%, and Elevidys is rebuilding from a restricted label. The PMO franchise provides cash flow stability while the gene therapy recovery develops.
Bottom line, the Elevidys label restriction is the defining risk. Bull case is label expansion and pipeline optionality. Bear case is a permanent ambulatory ceiling. The valuation prices in optimism that current results don't yet support.
Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.